and how many of them sold into the bull market, because bull markets are characterized by the market value getting way ahead of the cost basis, and are characterized by some of the older coins that are up 5, 10, 20x selling into the new buyers. So I look at those types of indicators to see, are we stretched here? And both of those still look kind of mid-cycle. Now, cycle structure could change, so there's no guarantee, but most signs to me still point up. 12 months, anything can happen. As numbers get bigger, it takes more and more to move the needle.
Yeah.
But the upside of that is it's a more liquid network. So Bitcoin in 2025 is more liquid than Bitcoin in 2017. I think he's more of a crypto aligned president, which includes Bitcoin. I think I wouldn't characterize him as a Bitcoin president. I mean, he did NFTs, they did DeFi. Now we got the meme coin on Solana. I think a lot of it is transactional. I don't think that surprises that many people about his history. I think it'll see what happens with the SBR. I think, for example, his incoming Treasury Secretary pick was at their crypto ball. So that's relevant. The fact that there's multiple pro-Bitcoin people in his administration is interesting. There's probably competing voices. He's a big proponent of Dogecoin in his inner circle as well. So we'll see how that shakes out. But I think the main takeaway is probably on the crypto side, you'll see more lax regulation. So the prior administration was characterized by a pretty aggressive SEC that tried to block things like spot Bitcoin ETFs, and was very kind of haphazard in terms of the things they went after, and even lost a lot of court cases. It was just not in my view, a very, and they wouldn't issue guidance on how to do things. If someone said, okay, we want to do real world assets or whatever kind of crypto thing you're talking about, they say, okay, if these are securities, is there something we can do to make these legal? And they kind of didn't really provide that. So I think the pendulum's probably shifting the other direction, which is unclear enforcement, as of yet unclear guidelines, and then the president himself has his own meme coins and their own kind of crypto securities. So probably a more lax and laissez-faire approach.
One of the things that Trump has to deal with kind of straight away is the debt ceiling. So will you give us an update on kind of where that's at and why tomorrow marks like a significant day in that?
Sure, and this is kind of quietly one of the more important macro things to watch, and the reason for that, and I'll get to your question in a second, the reason this is relevant and not just like a wonky detail is that the debt ceiling can affect liquidity. And as I covered in a report with Sam Callahan and other work, Bitcoin price actions historically pretty correlated with liquidity. It's not the only correlation, but it's one of the more sizable inputs to Bitcoin price in the intermediate term. And so the debt ceiling, basically ever since roughly World War I, instead of Congress micromanaging every Treasury issuance, they say, look, the Treasury Department can do those details, but you can't go over this limit. And that's different from authorizing spending. This is basically just how they pay for spending that they do authorize with their other bills. It's kind of like whether or not the government's going to pay their previously agreed to bills or not. Mm-hmm. And for roughly a century, it wasn't really used by one party against another. But ever since the global financial crisis, it's a tool. Now we're in this age of more political polarization. It's a tool that can be used largely from the out of power party against the in power party, or at least whoever is president at the time. It can be used against them to extract some degree of negotiation. And if it's not lifted, you get technically the risk of a technical default. In practice, usually at the 11th hour, it's fixed. And we have a fairly small sample size because it's only been used since the global financial crisis. Usually it's used against Republican Congress, against a Democratic president. But that's partially because most of the years after the global financial crisis have been run by a Democratic president. Democrats didn't really use it against Trump in his first term. And we've not really seen like intra-party usage. This, if it's used here, and so far it is a little bit, if it's used here, it would be the first time, at least in modern history, where the Republican Party is using it against the Republican president. And so if they do enforce it, and they try to extract concessions, then essentially the Treasury cannot issue net new debt. They can't increase the total debt load to the extent that some are due, so they pay out to existing maturing debt, and they can issue some new debt to kind of offset that, but they can't increase the total amount. And so they have to start taking what they call extraordinary measures. And that's the date that matters for January 21st, because the outgoing Treasury Secretary Yellen and her team estimated that the 21st is when they basically run into the actual debt ceiling and have to start shuffling their books around to keep things operating without issuing new debt. And the part that's relevant is that if this starts going on for weeks and months, they have to start draining their cash balance back into the financial system. So at any given time, the Treasury has a Treasury General account. It's their big checking account at the Fed. There's something like $650 billion in it right now. And if they can't issue debt, but they still have bills to pay, they can start draining their cash balance. And that's how they can keep running things for several more months. The last time this happened was the first half of 2023. And that, ironically, when the TGA is drained, it's actually pretty good for liquidity, because all that money is draining back into the financial system, excess, and so they can offset quantitative tightening with that unintentionally. And any excess liquidity from that will probably spill into the reverse repo facility. But yeah, that's basically all pro liquidity. And so that actually can be decent for asset prices.
Explain where you think we are in that liquidity cycle.
Right. So there's domestic liquidity and global liquidity. If you focus on domestic liquidity, there's basically a handful of big moving parts that determine what's happening with liquidity. So one is the central bank increasing or decreasing the monetary base. Basically, quantitative easing is pro-liquidity, quantitative tightening is anti-liquidity. Then there's other sources of liquidity. So because they did a ton of excess QE, a lot of excess liquidity was created, even more than the financial system could take. And so a lot of that was stuffed into reverse repos. That's kind of like a black hole of like excess liquidity, or a void to kind of put it there temporarily. And as they've done various anti-liquidity options, some of that is actually starting to come back out into the system. It's kind of like a buffer. So that as the reverse repo facility is drained, pro-liquidity, and then the TGA is filling it is negative for liquidity, draining it is positive for liquidity because it goes back into the system. So all those things kind of affect. One way to think of it is that if the government's spending but they're not issuing new bonds to do it, then they're spending money into the system and not really extracting money from the system. That's kind of juicing up the system. On the other hand, if they're borrowing money but they're not spending it yet, they're pulling liquidity out of the system and holding it in this void, their TGA, that they're not recycling back in yet. And so that can tighten financial conditions. The other things are harder to pin down, but it's like credit availability. So are banks tightening loan standards to various businesses and consumers, making it harder to get a loan than they were a quarter ago? Or are they easing their lending standards? They're more optimistic. They're a little bit more relaxed. That affects basically day-to-day liquidity for businesses and people. And of course, interest rates also factor into that as well. And then when we take a step back and look at global liquidity, a really big component there is the strength of the dollar relative to other major currencies. And the reason for that is because around the world, especially in emerging markets, but this is all intertwined globally, you'll have a lot of borrowing in dollars. And it's not even usually the U.S. entities making those loans. Like literally a firm in France could make a loan in dollars to a borrower in Brazil. It's because the dollar is global reserve currency. And the problem is that when the dollar strengthens significantly, all those liabilities basically increase in value relative to all these entities' cash flows. It could be a sovereign entity, it could be a corporate entity, and they start getting squeezed. And if that happens, a lot of these areas with dollar liabilities, not all of them, but a lot of them have dollar assets as well. On average, the world has a lot more dollar assets than dollar liabilities. And so they can start selling dollar assets, could be treasuries, could be stocks, and then getting dollars to service their dollar debts. So if a company in, say, Brazil has a dollar shortage, Brazil, as a sovereign entity, could help it. And it could be selling some of its reserves to get dollars to do that. And so generally any sort of spike in the dollar strength is pretty negative for liquidity when it happens, at least as one really big variable.
What do you think all of that means for Bitcoin in the next 12 months?
I mean, generally there's a bunch of variables. So the combination of ongoing fiscal dominance is pretty good for Bitcoin. Tariffs or anything that could reduce liquidity. So tariffs, a dollar spike, that's around the margins, negative for Bitcoin. So I would expect probably some of those events happen this year. They're probably not sustained for very long. Kind of negative liquidity is not really, it's hard to sustain for long periods of time given how levered the system is. The policy mix is probably neutral to bullish for Bitcoin. And then when I look at certain on-chain things, like really basic stuff like market value relative to cost basis, or the HODL wave, like what percentage of coins haven't moved in a year and how many of them sold into the bull market, because bull markets are characterized by the market value getting way ahead of the cost basis, and are characterized by some of the older coins that are up 5, 10, 20x selling into the new buyers. So I look at those types of indicators to see, are we stretched here? And both of those still look kind of mid-cycle. Now, cycle structure could change, so there's no guarantee, but most signs to me still point up. 12 months, anything can happen, but if I say 12, 18, 24 months, I'm still pretty bullish on Bitcoin at these levels.
I think we'll see more of a 2017 style bull market where we do have big drawdowns and it's not just up only, but therefore it goes higher.
We could. I think the problem is that as numbers get bigger, it takes more and more to move the needle.
Yeah.
But the upside of that is it's a more liquid network. So Bitcoin in 2025 is more liquid than Bitcoin in 2017. I think a lot of that money is pretty sticky. So I would generally expect, drawdowns to be controlled. But then upside, if you shoot upward really quickly, you do get a lot of selling pressure from older holders, like people that have been holding longer and that are up significantly, either rebalancing or upgrading their house, like they're the quote unquote buying the Lambo. You do see some of that cycle. So I think it is healthier not to go straight up and to kind of go over time. So it could certainly prolong the cycle in exchange for, less in any given 6-month period of going vertical.
One of the areas that I could see kind of big sell-off pressure from is I think that there's going to be a number of companies that try and do the MicroStrategy playbook. And I don't think many people are going to have the stones that Michael Saylor does in a bear market.
I think, yes, some of them might not have the stones. Some of them might not structure their debt as well as MicroStrategy structured it. So they even if they have the stones, they might just not have the choice. In addition, like how in the prior cycle, when GBTC's premium went away, that kind of marked the top roughly. Like after that was early 2020. It started chopping kind of sideways for a while. So that didn't blow things up right away, but it just kind of it took away this kind of arbitrage demand for Bitcoin. And you could see a similar thing, which is right now MicroStrategy is a huge buyer. They have a premium, so they're going to keep buying. And eventually, if they exhaust their market for a cycle, so it might not be permanently. They previously exhausted their market, now it's obviously a lot more demand, but they could for a period of time exhaust their market through no fault of their own, just the market only is so big, and then they go back to not buying anymore because they don't have a premium that allows them to keep issuing securities, and then you could remove that marginal buying source and then enter kind of a longer bear market. Maybe it's not explosive to the downside, but that can trigger kind of weakness, and if there are over-levered entities out there, that's how they can kind of send it down. So we have to kind of see what the market looks like in late 2025 or mid 2026. We can have this discussion again and see, okay, by metrics, how euphoric does this look? Right now, I think the industry is pretty healthy. No major signs of euphoria. Occasionally, you get little brief periods of slight euphoria, but nothing that looks kind of like a multi-year drawdown to me. So, and I think that'd be healthier to see a little bit less boom bust and a little bit more grinding higher over years would be ideal. I don't know if we'll get that, but I think that's ideal.